Excel sheet already has the clause number at the extreme left of your screen, where you will see which of the judgments impact which clause, and we'll go ahead. Before that, let us just spend about a minute on what are the amendments to the Form 3CD for the year for which we are going to do the audits, which is assessment year 21-22. Permit me to please go off video. I am on audio. As you know, I have high myopia. So for me to look at the screen will be a little tougher if I continue to be on video. So please permit me to be off video for a while. Coming back to what are the amendments that we're going to look at, I think there are 6 amendments which basically are of interest to us. One is that the tax audit report can now be revised till the end of the financial year, but the revision is only for changing the numbers of disallowances under section 40 and section 43B. Right, and we have to be very conscious that this is the only limited purpose for which the tax audit report can be revised. Otherwise, there is no provision in that sense for revision of a tax audit report, but basically recognizing the fact that we have to complete the tax audit report 1 month before the due date of filing return, whereas disallowances under section 40A1 in section 40 small a and 43B are not to be made if the payments are made before the due date of filing return. There is an opportunity available to us to revise the tax audit report. Now, does that really mean that we mandatorily have to revise the tax audit report? Because if we do not, the assessee may have challenges under 143(1)A when the CPC actually processes his return. Maybe we may need to in certain cases. I would still encourage that the clients be coached to pay the amount well in advance rather than filing up to the due date of filing of the return. Of course, if somebody has, I have a client whose year end for statutory purposes ends in September and they pay out bonus in November. And therefore, in my case, that return will compulsorily have to be revised. Now, the tax audit report will also have to be compulsorily revised before the return gets filed. So we will have those instances always, but I would believe that to the extent possible, we should avoid revising. We all know what problems technology creates. Whether revised reports will get picked up, not picked up, will always be a matter of challenge. But be that as it may, that's not what we're going to be discussing today. Just suffice to know that we are permitted now statutorily to revise the tax audit report till the end of the financial year for this limited purpose. There are a bunch of clauses where the inclusion of section 115 BAC and 115 BAD has been made, which is clause 8A, clause 18CA and clause 32, where the provisions of 115 BAC and 115 BAD have been added, and the reporting has to happen consequent to that. We will not again spend too much time on that. Clause 17 has been amended to incorporate the safe harbor for 50C and 56 to 10 and 43CA, which of course was enhanced from 10% to 20%, where transactions between 12th of November 2020 and 30th of June 2021, which are less than 2 crore rupees in value, have been done. And there the threshold for 50C or the safe harbor for 50CA, 50C, 43CA and 56 to 10 has been increased to 20%. There's another amendment in clause 18, subclause CB, where the reduction of the depreciation on goodwill, which is not eligible, is to be mentioned as far as the block is concerned. And lastly, clause 36, which dealt with amount of DDT paid and dividend declared, now no longer needs to be reported, as dividend is taxable in the hands of the shareholders. With that, let us go to the decisions proper. There are 31 decisions that we need to deal with, some of which we will deal with in groups, and we will take them very, very quickly. The first two decisions deal with ICDS disclosure. We all know that the provisions of ICDS prevail over those of the Act. And particularly in case of builders developers, where we have issues where land or building is held as stock in trade and there are borrowings, the accounting standard will mandate a addition to the cost of the asset rather than a claim of deduction by way of a debit to the profit and loss account. And therefore, that will create a mismatch, because when we file the return, we will claim the deduction under section 36(1)(3). Question is whether we can claim the deduction under section 36(1)(3) in spite of the accounting standards mandating otherwise. And here is one more decision from the Bangalore Tribunal, which basically permits that. It follows the Delhi Tribunal decision in case of DLF Limited, and says that where the provisions of the Act are in contradistinction to accounting standards, whether they be accounting standard 16 or accounting standard 2 or any other accounting standard, then of course the provisions of the Act will apply. Same goes for ICDS. And therefore, one would believe that in the ICDS scenario also, there should not be any issue in claiming the deduction under section 36(1)(3). This, of course, was a year prior to the introduction of ICDS. This was assessment year 13-14. There are similar decisions of Bombay in case of Palava developers, which is ITA number 2147 M20, dated 20th February 2020, as well as Pune Tribunal in Kumar Properties. I don't have the citation of Kumar Properties ready. I will send it to the chamber, later. But the Mumbai as well as the Pune tribunals also have held similar. The second decision is in case of Nokia Solutions. There, what used to happen was that the assessee was rendering certain services to different people here in India, and the revenue, because the contract was for 42 months, the revenue was recognized on time spent basis. So if say 100 rupees were to be rendered over 42 months, then depending on the number of days that the assessee rendered services, the revenue was recognized. The balance revenue, even if it was billed, was recognized as unearned revenue in the balance sheet. And the AO obviously wanted to treat the unearned revenue as income. The AO tried to treat the unearned revenue as income. But again, the Delhi Tribunal very clearly said that nothing doing. The assessee has, shown the revenue over time based on Accounting Standard 7, which is issued by our institute, and therefore that is not an issue. It examined one contract with Tata Teleservices and very clearly discovered that the recognition of revenue was over 42 months on a straight line basis, and therefore it said that this is perfectly fine. Now the issue really in that sense is that if, for example, there is expenditure, which we saw in the first instance, where we are allowed to debit it entirely, and revenue, which we have to recognize over a period of time, will that be admitted or will that be allowed or not? There is a decision of the Bombay Tribunal in case of Red Hat India, which is ITA number 7210, Mumbai, 2018, dated 27th of June 2021, where what used to happen was that there was a software purchased from an associated enterprise of this assessee by this assessee, and it was licensed to customers for a period of 3 months. Revenue was recognized over a period of 3 months. Expenditure was claimed on a purchase basis. So as and when the purchase were used to happen, the expenditure was claimed. And the question was whether the revenue could be recognized over a 3-month period. On the facts of that case, the tribunal has held that it would be useful to look at the facts of the case rather than assume this as a precedent without considering the facts. But I would think that this is another useful decision which one may be able to look at from the perspective of revenue recognition. We come to now the third decision, and now we will have few decisions on amounts not credited to P&L account, which is clause 16. And the first decision is that of OK Play, where the assessee had issued foreign currency convertible bonds, and it bought back these foreign currency convertible bonds from non-residents by way of a discount. So if say 100 rupees was the issue price of the bond and the buyback price was 98, 2 rupees was treated by the assessee as a discount, and it was not shown as income chargeable to tax. The department somewhere said that this is taxable. This is something which is taxable even as a benefit or a perquisite arising out of the business under 28(4), and the department sought to tax it. What happened in the tribunal was that the tribunal very clearly said that, look, this is something that is in the nature of a capital receipt, because the amount that was borrowed by way of the debentures was utilized towards capital expenditure, and therefore the discount falls in the nature of a capital receipt, which is not taxable, right? And the revenue sought to argue that this was a adventure in the nature of trade, and the tribunal said that nothing doing. The assessee does not issue foreign currency convertible bonds regularly. It does not do this as an activity to earn profit. So therefore, this can neither be taxable under 28(4) nor under 28(1) as an adventure in the nature of trade. I'm sorry, I should have actually moved the slides here. This is OK Play. The next one that we're going to look at, is Nestle India. And in Nestle India, interestingly, this deals with subsidy. So there was a subsidy received by Nestle from the government as a percentage of capital investment. And the question was whether this was to be deducted from the actual cost of the asset, or this was to just be regarded as a non-taxable capital receipt. The CIT appeals had actually directed to reduce the amount of subsidy from the actual cost of the fixed assets. There, the tribunal has gone into the decision. There, the subsidy was actually given by way of a refund of state taxes, which is VAT or sales tax, and has noted the fact that really this is not received for meeting the cost of any fixed asset directly or indirectly, but it is received only for investment in backward areas. And also one of the conditions was that 80% of your employees there will be local employees. And therefore, the tribunal said that if this is the case, then obviously the subsidy is not received for the purposes of reducing from the or to meet the cost of fixed asset, and therefore the reduction cannot be done. And it said that this is a taxable, non-taxable capital receipt, and therefore there should not be any tax, and it should not also be offered to tax. There is a interesting twist to this one, that if, for example, you receive such a subsidy for the purposes of transfer pricing, and I know most of us do not practice in that area, so I'll keep this very, very short. But an interesting twist is, can you offer this as an operating revenue to calculate your margin for the purposes of testing how much of a cost plus you're getting, if you're getting a cost plus from your aid. And in Hyundai Construction's case, ITA number 1766 Pune 2008, which is delivered as recently as 6th of December 2021, the Pune tribunal held that this was a capital receipt, certainly agreed fully, but this would not be operative revenue. This would be an extraordinary income. And in the facts of that case, what happened was that the Hyundai Indian entity was remunerated at cost plus. If you took this into account, the cost plus became very healthy. But if you remove this item from the revenue, then the cost plus actually became a negative figure. And therefore, the question really was that, all right, if I am indeed making losses and there is a subsidy received to, understandably meet the fact that I'm making losses if I set up in a particular area, then can the addition happen indirectly by way of a transfer pricing adjustment? In the sense that it may be a capital receipt for income tax purposes, but when I drop my accounts and my profit and loss account, I certainly would take into account the fact that I would receive the subsidy and therefore I would be charging that much less. But the whole point is that there is an argument to be made. Unfortunately, the tribunal doesn't deal with that argument in considerable level of detail. But one would believe that certainly there is some case to argue that I cannot bring back a addition on account of a transfer pricing, which otherwise would not, be sustainable. So I would believe that that is a little bit of a challenge in any case. Sorry. Then we go to the next two sets of decisions, which are Anand Prasad and Anand Kumar. I'm not sure, I am not able to display Anand Prasad for whatever reason. But in any case, there are two decisions. One is Anand Prasad, which is a Delhi tribunal decision, which is ITA number 7053 Delhi 2017, where there was a partner in a law firm called Trilegal. He had remuneration of about 3 crores plus, which was received from Trilegal, and he offered that for tax under 28 subsection 5, but he also claimed certain expenditure. Now, after claiming that expenditure, which was mostly in the nature of car expenses, he also did two things. He disallowed certain portion of the expenditure for personal use, and he also disallowed certain portion on account of 14A because he received an equivalent amount of about 3 crore 16 lakhs of share of profit. So he did the proportionate disallowances as far as 14A was concerned and as far as personal use was concerned. And then he claimed a deduction of the balance car expenditure. There, BAO said that nothing doing, he's not, given details, so on and so forth, blah, 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 and therefore he added back the expenditure. But the tribunal said that any income which is taxed as remuneration is business income, and any expenditure incurred to earn that income is business expenditure. And if it satisfies the relevant criterion, i.e., it is not personal, not capital, so on and so forth, then obviously it is allowable as far as the business income is concerned. So this is one decision which helps you to claim, a deduction as far as expenditure is concerned. I know that there are very many cases where at least we become a little wary in terms of claiming expenditure, like say, seminar conference expenses or car expenses or, electricity expenses at home when we work from home, etc. But obviously, this decision in that sense, particularly in cases of working from home, may help us and support us in claiming these expenditure. The next decision that is there on the screen is Anand Kumar's case. And this is a Madras High Court decision where there was a partner in 3 jewelry firms, and he received some income from this jewelry firms. And basically, he claimed 44 AD on this, saying that I am carrying on the business, and therefore I am allowed a deduction of section 44 AD. Now, there the tribunal or the High Court somewhere has held, the Madras High Court, that you are not carrying on business. It is the firm that is carrying on business. You are only receiving remuneration from the firm, and therefore you do not have what is called turnover or gross receipts. And therefore, there is no question of application of section 44 AD to you. You will not be allowed the benefit of 44 AD. Now, this actually brings us to a very interesting dimension to this. And the dimension to this is this, that if admittedly there is no turnover, there are no gross receipts, then whatever I receive from a partnership firm by way of remuneration should also not subject me to tax audit. So, for example, if I receive remuneration of more than 50 lakh from my partnership firm, as was the case, as we are aware, in Usha Narayanan's case in the Kolkata tribunal, where the lady was a partner of Deloitte, and she was receiving remuneration of more than 50 lakhs. There, the Kolkata tribunal has held that nothing doing. She needs to get her accounts audited, otherwise 271B penalty will be levied. Now, if we accept this decision of the Madras High Court, that there is no turnover and there is no gross receipt at all as far as a partner is concerned, then what do we do? Do we stop doing our tax audit, or do we really look at a facet where we say that, look, partnership is a relation between people where the business is carried on by all of them or by one or more of them acting for all of them. That's how the term partnership is defined in Section 8 of the Indian Partnership Act 1932. Now, if we look at that definition very, very closely, I would believe that a partnership as per the Indian Partnership Act is nothing else but a collective noun for a partner or some partners who carry on business together. And therefore, one would believe that looking at that particular, proposition which the law very clearly lays down, I would believe that somewhere the Madras High Court doesn't seem to have, and from the decision at least I cannot see that they've examined this part of the Partnership Act and looked at the definition. They've not in fact looked at the Partnership Act at all. But the whole point is that should we stop doing tax audit? I would believe no. As a precaution, it is always better to get the tax audit done. And as far as claiming of legitimate expenses are concerned, I would believe there is a case to claim legitimate expenses. Of course, everything has to ultimately satisfy the test of the preponderance of probabilities, and therefore you can't claim some outlandish expenditure. But certainly, if, say, for example, I do buy a very expensive car, and today cars cost probably more than houses, right? But if certainly somebody does buy a very expensive car, then after disallowing a certain percentage of the depreciation and the maintenance expenses, etc., I would believe that the deduction should be allowable, as was the case in Anand Prasad's case, where I think there was one of those fancy cars that was involved. And the same would, I would believe, go for things that we experienced while we worked from home, where we had a case of household expenses in terms of electricity, certain percentage of it certainly being claimable as far as a deduction from the remuneration is concerned, some part of our mobile phone bills, etc. All of that, I would believe, is certainly worth claiming. Moving on to
Anish, you have raised a very relevant about the tax audit. Can
Yes,
we have feedback from, because see, ultimately it is firm's business, no? Firm is, suppose whatever the receipts are there, that are firm's receipt. So firm is to carry on the tax audit. So again, we feel that tax audit is necessary.
Right. And sir, two parts to this. One is obviously the fact that the firm has already done a tax audit, and it has then claimed a deduction for the remuneration. So the question remains that when on the same business, on the same item of income, which is an item of expenditure for the firm, an audit has already been carried out, right? Is there a need to carry out another audit at all? Right? That would be one, dimension of the matter, certainly. The other dimension of the matter is that what is a firm at the end of it all? Is a firm a collective noun for a few partners, or is it a separate entity in itself? Arguably, it is a separate assessable unit for the Income Tax Act. And if I look at it from that perspective, I would think that, yes, the proposition that we were canvassing, that the accounts of the firm and the income and expenditure of that collective noun have already been subject to tax audit, and therefore achieving, or nothing will be achieved by subjecting the income to tax audit again. And we have the observations of the tribunal in the case of the mutual funds, in India Magnum Funds case, I think 71 ITD, where it said that if there is nothing to compute, what is it that you will ultimately achieve by doing a tax audit? And here again, one has to be very mindful of why tax audit was introduced. And would you therefore unnecessarily want to subject a partner who earns nothing or only the remuneration, which is in a way a mode of sharing profits, as the Supreme Court also held, to tax audit again? I would personally believe that there is a very good case for not conducting tax audit in the hands of the partner. Be that as it may today, the point still remains that should we really take the risk of penalty on our own heads? And that's why I think precautionary, ultimately, we are all professionals. I would think that ultimately the money which we pay to a fellow professional for fees remains within the profession, and therefore it remains within our fraternity itself. And therefore, as a precaution, I would believe that it's not worth it. But yes, certainly if somebody is in that situation, I would very well want to argue for him that he should not get his tax audit done.
Right, please.
Coming to the next few sets of decisions. Coming to SR shipping, which we can see again here. Sorry, I have one moment. I don't know why the Excel sheet is playing tricks on me. Yeah. No. Yeah. Coming to SR shipping's case, again, this is a Bombay High Court decision. Basically, it's a question of waiver of loan. And the question was whether this waiver of loan can be taxable. This was a loan waived by the government of Karnataka, and it was given by the government of Karnataka. And really, the revenue contended that if this loan would be waived, what would happen is that this loan would become what is called operational subsidy, and therefore this would become a revenue receipt, because ultimately it's a loan which is advanced to this assessee for carrying on of business, and therefore it would come back, because it was not to be paid back. It would become an operational subsidy, and therefore it would be taxable under 28(4), which the Bombay High Court rejected, which basically the Bombay High Court said that there is a difference between a loan and a subsidy. A loan is a borrowing of money to be repaid back with interest. Subsidy is not to be repaid back at all. And when a loan is written off or waived, it cannot partake the character of subsidy, because the essential character of this was something which was returnable in any case, and it was not something which was not returnable at all. So from that perspective, the Bombay High Court actually held that the waiver of this loan from the Karnataka government was not to be taken as subsidy. Related to this, there is something which we will look at, which is in ABB's case. If I can just change this thing. I don't know why, again, I'm sorry that the screen is playing tricks on me. But in ABB's case, which is, I don't know why the screen is not showing. Give me a minute if I can try here. Yeah. All right. I've got how to change this. Right. In ABB's case, we have a decision of the Karnataka High Court where what happened was that there was an advance made to its sister concern of about 3.5 crores. And the sister concern went bust, and therefore there was a write-off. So the assessee claimed this as bad debts, right? And also it wrote off the investment in the subsidiary as a capital loss under section 46(2). And there the department went into the age-old question of the fact that the assessee could not prove that the loan became bad. And therefore, the department was trying to disallow the bad debt. It also said that as far as the investment being written off is concerned, this is only a write-off. There is no loss. There's no transfer, and therefore nothing should be allowed by way of capital loss. Both these contentions were rejected by the Karnataka High Court. It basically relied on our good old decision of TRF as well as our CBDT circular of 2016, 12 of 2016, that after 1/4/1989, it is really not necessary for writing off of a particular, to prove when a bad debt went bad. The deduction will be allowable in the year in which you write it off. And as far as the claim towards the write-off of the investment was concerned, it relied on the decision in Jai Krishna, which is 231 ITR 108, Gujarat High Court, where it said that if you do not get anything upon the liquidation of a company, then it is to be treated as a loss under section 46(2). We come to the next case of Nokia Cyber Park. There, it's a limited issue, really. What is whether section 50C is applicable if leasehold rights in a building are transferred. I think we are now very familiar with the proposition that land and building or land or building is different from any right or land or building, and therefore it should not be covered for section 50C. We will come to one more aspect of this slightly later in one other decision, which we will come to. 50C versus what to reduce, which we will come to a little later. But basically, there is no disclosure, or I would believe there is no need for even a precautionary note if you transfer certain land or rights in a land or a building. The next case is again a little interesting, which is Jsw Steals Case, where what happened was that this assessee got amalgamated with three different companies. These companies were loss-making companies, and they had brought forward depreciation. And that depreciation was not fully allowed. And what the assessee did was that it said that when I amalgamate, my WDV of the asset has to be increased by the extent of the depreciation that remains unallowed in the hands of or unabsorbed. Let me not use the word unallowed because we'll come to what allowed means, but unabsorbed in the hands of the amalgamating companies. And therefore, my WDV, say, if was 100 and the unabsorbed depreciation was 10, in the hands of the amalgamated company, the total WDV would go up to 110 and not only be 100. Now, the revenue actually said nothing doing. The explanation is very clear for explanation 3 to 43.6, which says that unabsorbed depreciation is to be treated as depreciation actually allowed, and therefore what gets transferred to you on amalgamation has to be after reducing the total explanation. But then the Bombay tribunal has actually relied on the decision of Duma India, which is 310 ITR 392, which is a Supreme Court decision plus certain other Bombay High Court decisions and Madras High Court decisions. Basically, in Duma India, what the Supreme Court held was that if you want to say that something is allowed, then the person to whom something is allowed has to have had a tangible benefit from that allowance. And therefore, if something remains unabsorbed, then it is not to be treated as having been actually allowed. And that was relied upon by the Bombay tribunal here. And it was held that nothing doing, when you can, when you compute the WDV in the hands of the amalgamated company, then what you should also look at is the depreciation that remains unabsorbed, and therefore you will increase the WDV by way of that unabsorbed depreciation. The next decision that we look at is what I was just talking about, that when you look at the sale of land and building, and that land and building forms part of a block of assets, then what would you reduce? Would you reduce the stamp duty value, or would you reduce the actual consideration? We are aware that there is a special bench decision in case of United Marine 130 ITD 113, which says that you may have to reduce the stamp duty value, or section 50C applies. But there, one has to remember that in the facts of that case, what happened was that the block got extinguished, and there was a matter of computation of capital gains under section 45. Here, what is the fact is that the block is not getting extinguished. There is something still remaining in the block, and therefore there is no requirement of computation of capital gains. And if that is the case, then the tribunal here says that what you need to reduce is only the actual cost or actual sale value that you get of the asset. And I'm sure that you will have to do a computation first to look at, even if you apply section 50C, what happens? Does the block get extinguished or not? And if the block does not get extinguished for whatever reason, then what you are required to reduce from the WDV is not the stamp duty value, but only the value that you actually receive and the actual sale consideration that you get. And I think that this is very useful if we want to do this. As far as tax audit is concerned, I'm sure we can take this position with a suitable disclosure. This is a Delhi tribunal decision, but I'm sure this is quite useful. Then we go to the next decision of V Hotels Limited, where there was a payment for the use of FSI. And the question was, what is the rate of depreciation of FSI? Somebody was very cute here who said that this FSI is an intangible asset, and therefore I should depreciate it at 25% because FSI is a fungible FSI, doesn't attach to a particular building at all. And therefore, sorry, I will, claim depreciation on this at 25% because I can use it for any other. Bombay High Court said no, nothing doing. The FSI will, be attached to some building or the other, and therefore there's no question. And it is part of a building, which is, it is a right to construct a building. And therefore, from that perspective, nothing doing. It pertains to addition to the building only and not a separate asset. And therefore, you are able to depreciate it only at 10%, not at 25%. But I think I would give full marks to somebody for trying. The next decision that we will deal with is in the case of anachroma. And this is again something which is, very interesting, and sometimes, it can harm us a little bit. Here what happened was that the SSC actually transferred a business to Clariant by way of slump sale. And the question was that what is the, sorry, it got a business from Clarion. It was the purchaser. My apologies. And the question was, how do I compute the depreciation on all the assets? And there were two distinct aspects to this. One was that in respect of some of the tangible assets, the WDV in the books of the seller was actually higher than the fair valuation that the buyer did, okay, that Anachroma did. And that was one aspect that we will, remember. But it also claimed depreciation, rightly so, on the basis of that fair valuation, allocating it to various assets, liabilities, and a larger portion of the depreciation went obviously to goodwill, as we would have otherwise experienced. Now, this decision of the Bombay Tribunal somewhere says that this is a succession under Section 170. And the fifth proviso, as they refer to it, which is actually the sixth proviso to Section 32, which basically says that in case of a succession under 170 or an amalgamation or a demerger, so on and so forth, the depreciation will be the same as if the amalgamated or the predecessor entity would claim. And if that happens in the middle of the year, then you would divide the depreciation proportionately on the number of days. Our view always has been that nothing doing. This is not a case of a slump sale, is not a case of succession. And I would believe that here the tribunal has actually not appreciated the point, but it has gone on the principle of nocitura sources, which basically says that if there is a word which is in the company of other words, the word has to be read in conjunction or in a cognate meaning. Of course, that principle, again, in my mind, in a slump sale, somewhere the tribunal seems to have held that slump sale is also a reorganization as compared to succession or amalgamation or demerger. And therefore, even though slump sale is not mentioned, the color of slump sale has to be taken from the words that appear in that section. I believe this is not the right way of looking at it. I don't think the principle of nocitura sources actually says what the tribunal has said. But unfortunately or fortunately, this is what we are left with. There's one more aspect, as I had mentioned, that the tribunal also says that if the WDV of the assets in the hands of the predecessor is higher than the WDV, then the fair value that you determine, what you will substitute is the WDV. You will not substitute a fair value even for tangible assets. And therefore, your depreciation on goodwill will be reduced. Okay. That part somewhere can be a blessing in disguise for us, because now there is no depreciation on goodwill. I would believe that that principle also will not stand. But just in case, somebody has some case, at least as an alternate ground, certainly this is possible to argue. But I would believe that, again, this will not send or this should not stand the test of judicial scrutiny. But one will have to wait and see. As of now, one will have to face some challenge on this account as well. And this being a jurisdictional Bombay Tribunal decision, one has to be a little careful. The next decision that we deal with is in the case of Yes Bank Limited, which deals with Section 35D. And very, very small and very minute issue here is that when you deal with a placement to qualified institutional buyers, QIBs, is this still placement to the public for the purposes of Section 35D? And here the tribunal has gone into the SEBI regulations, etc., all the SEBI guidelines, provisions, and said that yes, it is. So from that perspective, at least it is helpful. Crescent Roadways, again, a very recent decision, and thanks to Dinesh Bhai for pointing this out and saying that, when you disallow employees' contribution to PF, etc., then that disallowance is prospective and not retrospective, relied on the explanatory memorandum, but certainly given, very clear direction now that this is a prospective amendment from assessment year 21-22, and for the earlier years, it should not impact. Then we go to GMR, which is a Karnataka High Court decision. And there are two decisions which I will flash together because that will be a little. And look at the other decision also of PENAR. Both these decisions are completely contradictory. Issue here is whether interest that you pay for delay in allotment of shares, is it a capital expenditure or is it a revenue expenditure? And the incidental question is this something which is allowable under 36(1)(3) or is it allowable under section 37? Facts are in both cases the same. One is a High Court decision, one is a single member tribunal decision. So please mind that the Delhi tribunal decision is only a single member tribunal decision. Facts are clear. I have got share application money. I had to allot shares in a particular time frame. I have not been able to allot those shares, and I have therefore paid interest to those people who eventually became my shareholders. Question is, should we follow Brook Bond and say that this is an expenditure in relation to issue of share capital, and therefore this is disallowable in light of the decision of Brook Bond, which basically said that all the other expenses, commission, legal expenses, so on and so forth, which are incurred in relation to issue of share capital also become capital expenditure. And the Karnataka High Court in GMR seems to follow or has followed that logic. But if we look at this single member tribunal decision of the Delhi tribunal in Penak's case, what the honorable tribunal seems to have held is that till the shares are allotted, there is a borrowing. Okay. And if there is a borrowing from the applicants, then the interest that you pay to the applicants is deductible under section 36(1)(3). And if it is therefore deductible under section 36(1)(3), then it doesn't matter whether it is capital or revenue, because any amount of interest paid for borrowings for the purposes of business has to be allowed. And that is the reasoning by which the honorable single member has gone. Now, with due respect, I'm not sure whether that reasoning is the most sound of reasonings. The reason is like this, that when somebody applies for shares, he is not paying you money with an objective to earn interest, right? You are not, again, contracting with him to pay interest on the money. You have defaulted in the allotment and you wanted the money as capital only. You have not taken the money by way of a loan. You will not show the money in your balance sheet ever if there was a cutoff at that point in time as a borrowing or a loan. And therefore, this logic of the deduction being available under section 36(1)(3), to my mind, seems a little difficult to explain, a little difficult to swallow. But be that as it may, we have something. I thought I'll point that out to you. We also have a decision of GMR, which in my view seems to be the more logical one. This is not a deduction under 36(1)(3). This is certainly a item which should go into the residuary head, and therefore, if the Supreme Court has said that anything to do with issue of capital is capital expenditure, and we have to respect the Supreme Court, then I would believe that the ratio of the Karnataka High Court is the more sound ratio as compared to what the tribunal has held. We'll go to the next one, which is Thacker Power Gas. And here, again, this is a Bombay High Court decision. This is a case of legal expenditure incurred in connection with the sale of capital asset. Okay. And the question was whether this will become capital expenditure and added to the cost, or is this revenue expenditure which would be allowable as a deduction from the total income of the SSC, the business income of the SSC. Here, the Bombay High Court seems to have taken the view, relying on the Madras High Court of Bush Woke Allen, which followed India Cements, which says that any legal expenses for borrowing money, irrespective of whatever, then this should be regarded as an item of revenue outgoing and allowed a deduction. There, the Bombay High Court has held that this expenditure would be in the nature of revenue expenditure, because there was a land which was sold in a subsequent year, and therefore there should be a deduction allowed as far as the legal expenses were concerned. I would believe that again, one would have to not look at this as a sacrosanct proposition. One could use it in certain very similar facts. I would believe otherwise, one may have a challenge, because normally what happens is, and particularly when you purchase a capital asset as compared to when you sell a capital asset, when you purchase a capital asset, whatever expenditure you incur should normally be added to the cost of that capital asset. When you sell a capital asset, any expenditure that is incurred directly with the sale of the asset should go as a deduction under section 48. But the whole point is that I don't think ever that it should be revenue expenditure. One has to be very careful, in my view, when you deal with situations like this. I would believe that somewhere one will have to be very cautious when one wants to rely on these sort of decisions. The next one is Bipin Chandra Hiralal Thacker, where it is on 40A1A. Very simple, that if you offer your income to tax on a presumptive basis, then there can be no disallowance under 40A1A. Surat Tribunal decision. Won't spend too much time on this. The next decision is interesting and deals with something that we normally do on a day-to-day basis, which is when there is a year-end provision that is made. Do you deduct tax or not? And there was this decision which was rendered in Tata Sky, which basically says that you have to deduct tax on year-end provisions. But there is a interesting twist to this one. There is, this decision was rendered by two members. One was Shri Mahavir Singh, the other was Shri Manjunath. And Shri Mahavir Singh also delivered, along with Shri Balaganesh, a contrary decision in case of Mahindra and Mahindra, which was ITA number 7328 of 2017, where the TDS on year-end provision was not required to be made. So there was an MA which was filed in respect of this decision, which is MA number 254 Mumbai 2020, dated 5/1/2021, where this portion of the order has been recalled, and it has been held that in light of Mahindra and Mahindra, you would not require to do TDS on year-end provisions. But I have 2 or 3 aspects to just share with you. Number one is that we need to be very careful when we make these year-end provisions. These year-end provisions normally should only be for period costs if we want to not deduct tax. The reason for that very simply is that if we make some kind of an ad hoc provision for an unforeseen event or a liability which we do not know, then I would believe that forget about deduction of tax at source. The allowability of that particular liability under section, or that particular provision, not liability, I would not use the word liability. The allowability of that particular provision under section 37(1) itself would be suspect. And if there is no allowance under 37(1), the question of 40A1 or 40A1A ought not to come into the picture at all. I would also caution that just because there is TDS done on a year-end provision under 40A1A ought not to automatically make the same allowable. I have seen people trying to make those arguments as well, saying that, look, we've done TDS on this, and therefore there is no question of allowance or disallowance under 40A1A. I would, be very cautious when I would say that. Again, there is a, you'll have different scenarios in different situations. There's a very recent tribunal decision, I forget the name, but there was a reward or a trip promised to certain salespeople for achieving certain targets, and that actual expenditure happened in a subsequent year. The actual travel or the trip happened in a subsequent year, where there was a provision made for this, the estimate of expenditure for this trip as on the 31st of March of a particular year. There, the tribunal has gone on to say that the amount crystallized on the achievement of the target itself, which I believe is the correct view. And therefore, you need not make any, provision on that date. The liability had accrued, but you did not know to whom you had to pay, how much you had to pay. And therefore, following the ratio of IDBI, which we are all aware of, the tribunal said nothing doing, you don't need to do TDS as on 31st of March. But I would think that that again is something which is, on the facts of the case, a good case to argue. I would believe that there is no one single proposition that applies to year-end provisions. And therefore, one will have to be very careful, very cautious when you look at year-end provisions when in your client's balance sheets. Please ask them for a breakup. Please ask them for the nature of expenses. Please ask them for, how they've arrived at the computation of the liability also. Do they know whom they have to pay, how much they have to pay, all of those questions. Because otherwise, we could land up in long-drawn litigation. And this is something that one needs to be, very, very cautious about. I will skip Sri Chaudhary Transport Company. It's been discussed, often. So I'm not going to, do that. Then the next one is Conwood Medipharma, where derivatives trading. There was a company which was into the business of derivatives trading. There was certain expenditure which was not debited to the profit and loss account, and therefore there was no question of disallowance of 40A1A. Department tried to disallow 40A1A, certain expenditure under 40A1A, and rightly so, it was held that nothing doing. There's no debit to the PNL, no claim of expenditure, therefore 40A1A doesn't. The next two decisions, and I'll try and complete everything in the next 5 minutes. I'm aware that we're already at 6:40. The next two decisions deal with 40A3. The first decision basically says that if somebody comes and deposits money into your bank account, then 40A3, should, in that sense, apply. Because if you deposit something into somebody's bank account and somebody had deposited somebody into one of the vendors, some money into one of the vendors' bank account and claimed that I am doing this through electronic mode because I am going and depositing money in his bank account, what he's getting is a credit from the bank, and therefore this is not a cash expenditure. Good try, but it is nothing doing. If I go and deposit something in somebody's bank account, it doesn't mean it is not a cash payment. And that's what the Allahabad High Court has held, that nothing doing. It has to be through those proper banking channels which are notified, and something like this will not be, allowed. The other one is that if, say, I incur expenditure in foreign currency, which is the Ramlord Apparel's decision, that if I incur expenditure in foreign currency, then will I get a deduction for that if I pay in cash? Because 40A3 talks about rupees and it doesn't talk about any foreign currency. There, the Mumbai tribunal has held nothing doing, sorry, but the idea is this is an anti-avoidance provision. And therefore, even if you spend in foreign currency, you will have to convert it into the equivalent of Indian rupees. And if your expenditure exceeds more than 20,000 Indian rupees, then obviously, to that extent, the expenditure will be disallowed. So spending in foreign currency again is not something that you will have. The next one is again on section 79, which helps you, which says that if there is no change in the ultimate holding company, section 79 does not apply. There can be debate on this. We will not get into that debate at all, but certainly this is something that we can use to help ourselves. The next one is no text is one where I would believe that it only proves what Mr. Micawber said in, the classic, this thing where he called the law whatever he did. But unfortunately, the fact of the matter is that prior to the amendment in 2015 to the explanation to section 73, what you did, which was non-speculative in nature, which was purchase and sale of shares if you were a company, was treated as speculative. And what you did, which was speculative, which was derivatives trading, was not treated as speculative because of a specific provision of the law. So you're dealing with two deeming fictions, that what is indeed speculative is not treated as speculative by the law. What you're doing, which is not speculative, is treated as speculative by the law. Of course, now after 2015, life is a little simpler, but only and only if the business of share trading is your principal business. So if you have two activities, one is share trading, something is other than share trading, then you're still left with this completely idiotic anomaly. Sorry to use that word, but yes, I believe it is completely idiotic, that something like an explanation to 73 should be regarded in its proper context, that it should be used. We have enough anti-avoidance measures in the law. It should be used only and only when there is at least a prima facie case of tax evasion. But as we are all aware that the department uses it mechanically, and unfortunately it is what it is. At least there is some relief where your principal business is that of share trading. The next one is Goldman Sachs, where CSR expenditure was disallowed, but ATG was allowed, just kind of to help us claim that and argue that. And if somebody were to deny that, then that was what it would be. Next decision is Union Bank of India, and it is on the fact that if you take 15G and 15H from your depositors, are you then required to do any more due diligence? There the Jaipur tribunal said no, nothing doing. You are not required to do any more due diligence. It is a statutory requirement. It's a form which is prescribed by statute, and rules ask you to take that form. Once you take that form, it is fine. You cannot be held to be in default of non-deduction of tax. The next one is universal cables, which is for interest to a tax deductor. Somewhere the department tried to say that this person is not an assessee at all. He's just a deductor, but of course that contention was in that case negative. The next two decisions, which are on deemed dividend, again, I would want to just say that the facts of each case are important. And particularly if you look at that last decision of Dharia, you will see that they had just classified a current account as intercorporate deposit. And when there is no terms of deposit, there is no resolution on accepting deposit, there is no invitation to accept deposits, the transactions between the two sister concerns are done on a regular basis, just calling something intercorporate deposits is not going to help. And therefore, I would believe that one has to be very, very careful. People try and argue all sorts of things, but it just becomes a little bit of a challenge.
This presentation won't work for today's meeting because the things are that the website is under constantly updation and the issues keeps on cropping up. I I think today's meeting we start discussing with issues only. That would be the better thing. So each of the things, those who are having the issues, they can keep on posting the issues, and I will start discussing. I have several issues which we have also from chamber side. We are representing it. So one such issue was today that 3CA, 3CD was one of the issues which was getting up that was not getting uploaded. But from Saturday, last Saturday, the issue has been sorted out. 3CA, 3CD utility has been amended. And now 3CA, 3CD has started uploading. And the issue was that 11, clause number 11, 11 A to D, there was some error. The report was not being generated perfectly. So that issue has been resolved. And one CSV feature has been added. So now if you have entries which is exceeding 500 in clauses especially related to TDS and TDS clauses are there, or wherever there are major entries are there, you can import directly through CSV. So that new feature has been added. Here when you are entering it in 3CD or any of the forms which are there, you have to just see that in the audit reports, or whatever the reports are there, whatever the red asterisk marks are there, they are mandatory. So if you don't fill up any of these details over there, it will be giving you the errors and your reports won't get uploaded. Same issue was there in 29B, and many issues I am getting here from many members that 29B are not getting uploaded. So one such issue in 29B is that last column which is there, wherein the remarks has to be filled. So in that remarks column, though there are no remarks are there, you have to just write nil or something has to be mentioned in that. Unless and until you mention anything over there, the Jsw does not, Jsw is getting validated, but submission is not happening. So please take care of this. Then today 15 CA and CB withdrawal feature has been enabled. So 15 CACB, there is some issue which has been going on that it is taking 1 day to approve. So that 1 day to approve, and in between what had happened in 15 CACB, the address of the SSC has been appearing in place of the signatory, that is where the chartered accountant's address has to appear. In that place, the SSC's address has been appearing. So that issue was been pointed out, that has been rectified now by the CPC. And in the audit report, we had demanded from them that in the earlier auditor report, we had a residual column to report at least 2,000 characters field was available in the main audit report. That was not there in the form 3C and 3CD, which has been added in the new utility, which has been amended on released on 9th of December. So that has been added. And in representation, what we have pointed out that we have given the 10B form is still not getting validated. The 10B and 10IC is still issue, which is under updation. 10B form is getting uploaded, but e-verification is not happening. So unless and until the 10B audit report which is there, that is for the charitable trust, which is mandatory to be filed. And unless and until this 10B is being filed, you cannot upload the income tax return. And now the due date is still being, the due date is approaching. So that is under updation. So please don't try 10B and don't waste your time. And 10IC also some fields are there. 10IE form is now updated, so 10IE is getting uploaded successfully. E-verification, some of the forms are not being uploaded. So if any such issues are there, what you have to do is you can just take the screenshot and raise a complaint. And raise the complaint and send the screenshots to them. Don't just keep the screenshots with you and raise the issues and they will contact you. And one email ID which is available, that is e-filing web portal @incometax.gov.in. Send a mail to them. Downloading of the income tax returns and acknowledgements is an issue. So in that case, whenever there is a downloading issue which is happening, then what you have to do is wait for some time and log in and log out, and then you will be able to download the returns. So that is also happening successfully. But in case if it is not happening, once your return has been downloaded, and if you are unable to upload it and you are unable to download it, just keep a screenshot of that and save it, so that in case if that in future if the acknowledgement is not available, you can just raise a complaint and get it resolved. And one more precaution I would like to say, that because since the website is under development, many a time what it is happening, website is getting hanged. And after some time, if you file the form, trying to file the form again, it says that the form has been submitted. So if it is showing that the form has been submitted, then also you take the screenshot of the same. Maybe if that the form has been uploaded, the form has been submitted, the acknowledgement may not have been generated. The acknowledgement will be generated subsequently. The system has uploaded, taken the form on record, but due to some system or technical error, the form may not be available. And especially in case of 3CA or 3CD, one more problem which has been identified is that if you are withdrawing the form, or if there is some error in the form, and the 3CD has not been accepted by the SSC, and the form is being withdrawn, then again add CA has to be done. That error has been pointed out, and now see that, because yesterday we had 2-hour WebEx meeting with them, and this issue was pointed out to them, and they are seeing that this error should not have happened, but they tried it from their side, and it was the issue which was, they realized that it was a mistake from their side, that they are trying to resolve it. And after making this form 3CA, after adding that CSV option, they have seen that the many a time the JSON which has been generated, JSON actually has the errors. So while submitting any income tax returns, though it has been generated from the software or it has been generated from anywhere, you have to just see that it is being run through the utility, because many errors are there in the system. So the errors may not be identified by by the software, but it will be identified by the system. That is what I would like to say to everybody, though it will be taking some time. But since the income tax website is new, so if it is better that we spend some more time in filing the return rather than we get some demand notice or any notices subsequently, or rather than we don't get the 139.9 notice subsequently after filing the returns. So these precautions should be taken this year, and it is a better time that the representation be sent earlier to them, so that extension is being granted earlier. So this is basically from my side for this precaution what has to be taken. 164D form has been released today, and I think all the forms are now activated, but verification is still being an issue. So any questions, answers, or any discussion related to the issue with the form, we can pick it up. The forum is being open for this. We are trying to pull out the form 10I, however we are able to do so, the system throws an invalid input error. I think today morning we have filed one 10I form. I didn't see any error is there. And basically, see, don't try to use any, wherever you are finding some error in uploading the form through any private software, then in that case, you try to upload it to the income tax departments directly, try to file it online. Then this will be helping, this will help you out rather than using the private software. And in many cases, what has been happening, because the income tax department has been releasing the online utility faster, and software people is generally they are releasing the schema, and schema takes normally 2 to 3 days to update. They release 2 or schema for the private software people after 2 or 3 days. Once their utility is being stabilized and when there are no errors. So this is the precaution which has been taken by them this year while releasing the new schema for the private software providers. So this is the and in ITR 5 and ITR 6, they have come up with the Excel utility, and from the Excel utility, the JSON file has been generated. So whatever the JSON earlier, the JSON which has been generated, you can download the JSON, and that JSON file you can upload it in the newer version which is released by the Income Tax Department. So that option is available. You don't have to again refill the form, and just that is this we have to revalidate it. And because one thing which has been identified here is that even if your JSON file is correct, but when you run through the when you generate the PDF reports are not getting correct. There are errors in the PDF report. So if there are errors in the PDF report, then you don't upload the file, JSON file, because ultimately the PDF reports are the final reports which are there. So in that case, if you get the errors in the PDF report, then also you raise the grievance. Don't just upload the form. That is one of my suggestions which I would like to share with you. Any other more questions which you would like to discuss? Then discuss.
Deepesh, are there questions?
Then about one 3CD error which was identified, that many of the people who have filed the 3CD reports between 3rd December to 9th of December, they have uploaded the 3CD form. And in that case, there has been the error for that books of accounts maintained error has been there. There is in clause number 11 there has been error. In that case, I would request that I have raised the issue with the CPC that this error was there. In that case, I would request that still the time is there. Please file the revised tax audit reports report and get this, because in that case, many cases it has been found out that the report it says that books of accounts. Many PDF final report has been generated with stating that the books of accounts maintained is stated as no. So please revise the tax audit report, because there may be penalty which may come in future in that cases. So the time is there, so you can revise the tax audit reports in that case. And system still is not accepting the UDIN, and so you generate, once you have uploaded the tax audit reports or any audit reports, you generate the UDIN, and subsequently you will be required to update the UDIN on the income tax portal, and for that also the web portal is still not ready. The time limit for that is also extended to 15th of January, and let us see that till that time also the web portal is ready or not. Again, the time limit may be extended. It's for that, because they are first, the priority of them is to first get the portal fully updated with all the returns and filings. Then 15 CSCB also, it takes almost around many cases it is taking time to 24 hours to 36 hours in many cases. And also in that case, many errors are being found. So 15 CA and CB also ensure that you get the prefigures reports finally correctly when you submit the forms. So that also is one of the error which has been found out. Then about utilities, constantly there are updations which are there. So whenever you are uploading the form, you basically download the new utilities and then you fill up the new utilities and then only you upload the form. Don't use the old utilities, because here in many cases it has found out that in earlier version, that is old website, whenever there was updation in the utility, it used to instruct you that you use the new utility, but here there is no, it is not asking for to upload the JSON through new utility. So that is one of the error which is there. Then statistical information still shows that 3 crore returns has been filed as against 9.5 crore filers. So a lot of pendings are still pendings are there. Filers are pending. So last day still rush will be there. And 29 reissue has been resolved. That is one more question which has come. Then acknowledgement pending is downloading is pending. So don't waste the time in just take the screenshot and is there. And profile updation. So profile updation, especially when you before filing the return of the income, you see that your all profile is first updated. Your bank account validation is being done. And whatever the bank accounts which are there on the website, that is web portal, if any of the bank account which is there on the web portal is not in operation, kindly remove that bank accounts. And whatever the existing bank accounts are there, please validate at least 2 bank accounts should be were nominated for the bank refunds. So that will help you out subsequently that whenever the returns are being processed, because it is generally seen that ITR 1 and ITR 4 are normally processed instantly because many people have got the refund within 1 or 2 days of filing the returns. So upload this, file the returns, and before filing the returns, get this facility, this validation of the bank account done. And another advantage of this bank account validation being done is that you can e-verify your return through bank account also. That is also one e-verification facility which has been added. So that will also help you out in case your mobile this other verification does not work, and other verification is not working. That is also one of the biggest advantage. Second, this about in case of HUF and AOP, there is in profile updation, there is one bigger problem which is there, that is date mismatch is happening. So wherever the date mismatch is there, either your PAN card is correct and the details which is there, which is coming on the profile is not correct. The errors are which is there, then you please raise a request e-file on the e-filing web manager at the rate of income tax.gov.in. And another feature which is there, that if you put this incorrect password for 4 times, then your this income tax portal gets locked for 4 hours. So see that you remember your password. Don't forget your password also. That is also precaution which you have to take. Then AIS also, which has been, so while before filing the returns, you have to ensure that the returns which you are filing, the cross verification is being done with the AIS also, AIS. And rectification this has also started. You can just file the rectification wherever the notices have been received. You can file the rectification that is also being enabled in the system. Digital signature is that you can use this digital signature. Earlier you used to use digital signature has to be there on the portal, this fixed to the desktop or to the laptop where you're filing it. Earlier the digital signature was not mandatory. So it means you have to, the digital signature was to be generated, but now it has to be affixed to the laptop or the desktop from where you are uploading the return. So that is mandatory now. And same digital signature, this digital signature, once it is registered, it cannot be deregistered. And for deregistration, you have to send a mail to the mail to the income tax department on the registered email ID. Then only they will. There's a set procedure which needs to be followed to deregister the digital signature. So there cannot be more than one digital signature registered on the new income tax website. So that is one of the changes which has happened. That precaution that has to be kept in mind. I think this is the thing from my side. Any other question, answer? How does one can get the old intimations from 143 from AAY 2013 and 14? This is available. You can go to the view file returns, and then from that you can download the old intimations which are now available on the website.
ये इसको फोन करो, नम्रता को क्या चाहिए उसको.
I think this is what is the present status from my side. If any other issues are there, I can definitely take it up.
Can you speak on this legal hair registration and the estate return to be filed? Now some formalities are to be done.
Legal hair registration, the formality remains the same only. The thing you have to get there are three things that is you should have either a registered will which is there, PAN of the deceased should be there. This PAN of the deceased and PAN of the authorized signatory who is nominated through the will. That person should be there, and the procedure is the same. Which was there in the earlier. Only the thing is that the documents has to be attached to this and uploaded, and then at that time once these documents will be verified by the income tax department, and this will be validated, and you'll be allowed to file the returns.
If will is not there, then
release, and there are other two documents which are there. That is other two documents, like you can have this certificate from the bankers as per the format, or you can have an affidavit which is from the notary, or you can have a gazette from a gazetted officer. That is also permitted. There are a list of documents which are given from the bank on the website which is available. So any of the document which is there, you can just attach it, and based on that you can apply for this change of this, and you can get this legal aid registered.
Gazetted officers, yes. You have to go to your assessing officer,
The list is given, this is provided on the website. There are a number of persons which are there who can be a gazetted officer. The best person, you can go to if the joint account is there, and joint account is there, then you can go to the banker. The bank's manager certificate is also valid.
Okay.
That is the best option.
If joint account is in the name of husband and wife,
wife can become a legal hand.
Yeah, but then son cannot become. I am told. Yeah. Whoever has joint bank.
Yes.
Dipesh, are there any other questions?
Yeah, there is one question which is regarding this legal heir only, that there is only one legal heir and she is not in India. How to get it notarized in such case? I think
notarized, you can have it a foreign notary and be accepted.
Yeah, foreign notary.
Foreign notary is accepted. Otherwise, the bank
sorry, if I can ask, there is one issue that in case of the notice is received, say 148 or whatever, the against which one has to file the returns. So many times what happens that if the e-verification or DSC failed at the time of uploading the XML, then the said option is not appearing. It shows that the response has been submitted, and then you can't go and e-verify. And whenever you download the acknowledgement, that is unverified acknowledgement.
Now that option has been removed now. Last 2 days, if you see, they have removed the option that once that digital signature or e-verification for this is now not required.
For written file, it is not required?
Now, written filing it is required, but what it says now, for submission of
against 148, you need to upload the return.
Right.
So you need to go to that e-proceeding and go to submit response, and then it will take you to the return uploading screen.
Right. Okay.
So once you upload the XML, if somehow that verification process fails, the return has been validated, but the verification process has not been done. But still, when you next time again go, you will see that the return has been uploaded. So that you download the acknowledgement, that is an unverified.
So you can just e-verify the return, because that will be pending for e-verification. So there is a process for e-verification which is there.
Yeah, but in that pending for e-verification, that particular item, all the status is pending for e-verification.
So you can
e-verification, how to do e-verification, because that option is not coming.
That option is, if you say 1 minute.
And say a company's case, it was actually supposed to be done by DSC.
So in company's case, actually it was to be done by the CS.
Now the return has already been uploaded. So how to
Then you will have to, what you will have to do is you will just raise a query with that, raise a query. So they will enable it and they will allow you to do it.
Okay, okay.
You raise a query with that email ID which I have given you, e-filing web manager, @incometax.gov.in.
Okay, noted, sir.
You just raise a query with them because there are many issues with it.
Since CBDT has recently issued a circular that this will not be considered for the purpose of assessment, but still this is very important, very valid, and maybe it is not considered for this year, but it will be considered for coming year and onwards, and maybe it will also be considered for the purpose of scrutiny, selection, etc. And since the informations are very vital, and we need to check, we need to report, we need to give feedback. So we need to understand this. And you will believe that government is spending crores of rupees on this project Insight. So there must be some purpose. It is not just created for simple purpose. Though they have said it will not be considered, but so many things would be considered in my personal views. So what is Project Insight? Income Tax Department initiated Project Insight to focus on 3 goals: to promote voluntary compliance and deter non-compliance, to impart confidence that all eligible persons pay appropriate tax, because if the information is readily, handily available, they will be, yes, having confidence, and they will also be willing to pay the proper tax. To promote fair and judicious tax administration. These are the 3 purposes by which they started this Project Insight. And for this, they have 2 these centers. So one is Income Tax Transaction Analysis Center. So in Income Tax Transaction Analysis Center, they integrate the data, process, the quality monitoring of data is done, warehousing of data is done, master data management, data analytics, web text mining, alert generation, compliance management, enterprise reporting, and research report. So all this kind of data, validation, storing, monitoring, everything happens in this particular center. So this center collects all data, process them, and then monitor them. This another third CPC of Income Tax Department is Compliance Management Centralized Processing Center. In this particular center, CPC, they use campaign management approach. So we receive a lot of emails, SMS, reminders to file returns. The time is getting barred and etc. You please file. So this all is we are getting from this CPC center. So they send all the mails, SMS, reminders, letters to support voluntary compliance and resolution of compliance. It is a dedicated compliance portal used to capture response on compliance issues. So even certain responses which are being given, even they are being captured here to look into the compliance and for effective compliance monitoring and evaluation. So we have new avatar of 26AS by this Project Insight. So what we used to call 26AS is now extended and would be known as AIS. And so Amiji was calling it as a threshold day before yesterday in DCA, AIS and TCS, 26AS, AIS and TS. So what is AIS? AIS is comprehensive view of information for a taxpayer displayed in 26 form. So 26AS, whatever we were seeing, now we'll see much more comprehensive. Not only it will be much more comprehensive, which I'll be sharing that 50 kind of informations, 50 kind of incomes, which will be or transactions which will be covered, that I'll be sharing in future, in coming time. So what they are saying, not only that sharing, taxpayer can provide feedback on information displayed. So AIS will give both reported value, the information which they have received from other basic source, and modified value. Modified value, the value which is derived after feedback of the taxpayer. So under each section, there is section of TDS, SFT, other information, etc. So in under each section, you will have text, direct information and information after feedback from the taxpayer. So modified value is after considering taxpayer feedback. And what is TIS? TIS is summary of the information. So if you see in AIS, there are hundreds or maybe thousands of information. But if you want to have the categorized information summarized, so suppose what is my total income from salary? What is my total income from rent? What is my total income from dividend? What is my total income from interest on saving banks? So these are all categorized into different categories, total aggregate of that income. So in AIS, you have all the different details, but in TIS, you have aggregated summary that under each category, what is the information summary that we will get, wherein there will be two information, one will be processed value and one will be derived value. So how you get processed value? So what happens, for example, I'll just share a small example, say dividend. Dividend is known to the department through two sources. One is through TDS returns. So TDS returns filed by mutual fund or companies for against shares dividend declared. So they will be filing return in form 26Q. From there, they will know those informations under section 194, 194K, etc. The second will be in SFT. So in SFT, all details. So only those details where TDS on dividend is declared is in form 26Q. But the other TDS, where other dividend, where there is no TDS, say dividend below 5,000 rupees, they will all be reported in SFT by the companies who are declaring the dividend. So information is given at two places, one in TDS, one in SFT. Now the department will compare the two. And wherever the amount is lower, that it will ignore, that it is known as deduplication. So out of the two informations or three informations, so whichever is the least information, that information will be ignored. So I don't know why this particular information given by the department is not talking of equal. They are talking wherever the least information, that will be removed. But if the equal information is there, if the amount is same in 26Q or under TDS and under this, they have not mentioned if the amount is same, what will happen. They have mentioned the D, but I believe that definitely they will be removing one of the two. They are saying the one which is least we will be removing. So process value is determined after this deduplication, after deleting the information lower part of it. So suppose in SFT, the dividend amount is say 73,000. In TDS, the dividend amount is say 40,000. So 40,000 will be deleted because it is deduplication. And 73,000, the amount given in SFT will be considered for the purpose. That is known as process value. So initially I have two informations, 40,000 and 73,000. Now 40,000 is deleted, deduplications of information. 73,000 is taken, that is process value. And then derived value. Now what may happen, the taxpayer may give feedback to the department that this even 73,000 information is not correct, this share I am not holding, or this is a joint, or maybe some mistakes are there in information, or some PAN number mistake is there, or something like that. In that case, after considering the feedback from the customer, they will change the process value. So first they have taken the information, then they have processed the value, then they have reprocessed that same process value after considering taxpayers' feedback would be known as derived value. So that will be there in the TS. So if you'll see salary income, then how much amount under process value aggregated, and how much amount under derived value. So how these functionalities of AIS happens. So we can view annual information system. We can submit feedback on AIS. Now what happens in when I go and view annual information statement? So I will not be able to see if in one category the data is more than 100. So suppose TDS from dividend is more than 100 companies have done. So that information will be showing only 100, not beyond. Or is the aggregate, all total information in the annual information system under salary, under dividend, under rent, all others, this is more than 1500, then again it will not show, it will show only to that extent. So in that case, one has to go to download PDF files More than 100, then one has to download PDF file or JSON file. So if information is more than 1500, then it will not come even in PDF, that will come in JSON file. So one has to download to verify, to check or compare the amount according to the taxpayer as well as according to the department. So these are the different way of looking. You can view the form, you can download it in PDF, you can download in JSON, you can download it in CSV, you can download it, again, you can download consolidated. What is the total amount of this? Like TIS, what I said. So they will be in sort of TIS. So those can be aggregate also. You don't want to go through the total detail. You want to just check if my dividend amount as per AIS is more or my amount is more. Maybe then you are feeling little comfortable that if my amount is more, so I am taking care of it. So there are different different formats in which these informations can be downloaded. So what AIS has, it is divided in two parts. So it gives general information, name, PAN, Aadhaar number, date of birth, or date of incorporation or date of formation in case of partnership, trust, etc. It also gives mobile number, email address, address of taxpayer. So now what is one good thing is that you know what is the email address as per department. Maybe your address, you have not changed, the taxpayer have not changed. So one will be able to, now what happened in case of faceless scrutiny, we did not receive the notices. Later on, we realized that the SSC staff accountant who left 5 years back, still his email address was there, notices were going there, and the SSC was not getting notices, etc. So there were a lot of problems. People were not knowing what the actual information department has. Now it is handy. You know that what is the address as per department, what is the email address. You can go and change, rectify your profile whenever there is something mistakes and all that. So it is good that every time when you go and open the AIS, you know what is the latest information with the income tax department in terms of your email address, address of taxpayer, mobile number. Even mobile number might have changed and all that, whether it has been updated in income tax department or not, one can look into. So it is very crucial, important, though one may look at general information not so important, but what is the latest and whether I have the taxpayer have done proper change or not, whether it matches with this, it needs to be looked into. And part B is TDS, TCS information, SFT information, payment of taxes, demand and refund, other information like annexure to interest on savings account, outward foreign remittances, purchase of foreign currency, etc. So many other informations are also there in AIS. So how do
if I can ask, what is the source of information for this email and mobile?
Pardon, I did not get the. I could not hear.
What is the source of information for email address and mobile number?
What is in the department's record already? Department has already the records. They are sharing that only.
Because in few cases we have found that the email address which are appearing are not, known to even to the client.
So one has
we are not able to trace the source from where this has appeared.
Doesn't matter. One has to go and change the profile and see. So you are really feeling happy that department is telling you what information they have, and you have an opportunity to change, rectify your profile and get it done.
No, in the profile it is not matching with profile. It is from somewhere else. So does it mean that we have to get it through this 49A correction, PAN number correction?
According to me, yes.
Okay. Thank you.
Now, suppose we have so many issues, so many problems, or like my talk would be hardly of 1 hour, the time given by Asukji. So what happens, we have the problem, we have issues like this particular issues, what is the source, etc. So they have, nowadays department have become very proactive and they issue lot many publications, etc. So they have issued these 5 publications. AIS Utility User Guide version 1.0. This is issued in October 2021. AIS Portal User Guide version 1.0, AIS FAQ, wherein they have given all the questions, they have answered themselves like 100, 1500, and all these questions have been answered in that. So one can know that if I am not able to download in PDF, why, or if I cannot see all, why. These are all questions have been answered. Then AIS utility PPT version 1 and AIS handbook version 1.0 again approved. So it is of 103 pages like a handbook. So maybe at times one may not be having so much time to go through, but the junior staff or somebody who's looking into this particular thing can be given these all 5, or one must look into the particular issue which is facing from these sources, and one can get the answers. One need not worry, even though they have in AIS they have chatbot. So chatbot, you can ask, they have artificial intelligence enabled software, wherein if you ask some questions, you will get the answers. So you can have conversation through chatbot, or also there is in AIS homepage, there is help desk. So one can go and take the help, can raise the issues, and you will get the feedback based on the help desk also. What is the key objective of AIS? Display complete information to the taxpayer, promote voluntary compliance, and enable seamless pre-file. So one of the major purposes is that in days to come, we will experience, in years to come, we will experience that our income tax return is pre-filled, and this pre-filled is through AIS. So AIS ultimate objective is to pre-fill IT return so that SSC taxpayer is comfortable and is able to file the return with much ease and comfort, and chances of missing certain information etc. are minimum. It will deter non-compliance also, since he will know that my already saving account interest or my salaries or my so many multiple accounts etc. information are already there, say transaction information already there. So non-compliance will not happen. One will be worried, one would be looking into those things. So what is a salient feature? So a salient feature is now the information in 26 years was very limited, but we'll see now, we'll be sharing later on, that there are 50 kind of informations, transactions being reported, like interest, dividend, security transaction, mutual fund transaction, fundamental, like that there are 50 kind of. So the inclusion of new information, there's a lot many informations have been included now, and maybe in time to come that 50 becomes 100, we never know, or maybe more. Another thing is that use of data analytics to populate PAN in non-PAN data. So suppose somebody has filed SFT return of dividend. Now in dividend, they have not been giving the PAN number of a particular person. So one that SFT return PAN is not given, but still department will try to match the informations through AI, artificial intelligence, and if they can, if they are finding something like in terms of name, address, or something matching, and which matches with PAN, etc. So maybe they will try to populate those data, which is not the person who's giving the information is not giving the PAN number, but the department will try to find out through artificial intelligence and populate that non-PAN transaction into a PAN data and bring it in AIS. Then again, there will be deduplication of information. Like I said, that there are multiple, same information is coming from multiple sources, in TDS return, in SFT return. So they will compare the two, and the one which is list will be removed, will be classified as deduplication. So wherever the information in SFT, TDS, or other information, if same information is coming at twice or thrice or multiple places, then they will compare the informations. The one which is with the higher value will be remain, and the deduplications they say. So pre-filing will be enabled in a phased manner. So they are not doing pre-filing right now, but right now they are doing some information, and some information will in years to come we'll see that pre-filing from AIS is happening in our this thing. And taxpayer, what is another feature is taxpayer can submit online feedback on AIS information. This is one of the most crucial. It is not one way now, it is two way. You don't see just 26 AIS and feel that this TDS is not related to me, why, what can I do and all that. Now we can give our feedback, we can get it corrected, we can so many informations which are like joint owners, co-owners, so many issues we face, that all PAN incorrect information, etc. So we can give feedback on AIS information. Another thing is that you can not only view this particular AIS, but you can download also in various formats like PDF, JSON, CSV, which I said earlier. AIS utility will enable taxpayer to view AIS and upload feedback in offline manner also. So it's not necessary that you have to do everything online. You first may prepare offline and then can upload. The great thing is that department going forward is also going to bring mobile application. So one can see it on mobile and one can also upload feedback on mobile. Though it has not started right now, but it is intended and it will come in soon. So when they prepare population AIS preparation in the process, they also do PAN population, which I said that they try to find certain informations where there is no PAN number, but they try to match and they try to see from the information they can find if that person has something match and they can find PAN. They try to cover that. Information display, information. So they process also deduplication, which I said. So in multiple category, then they will remove that. Taxpayer information summary, like in 26 days we were not getting summary, like total amount of rent, total amount of dividend, total amount of interest, total amount of selling, or so many other things. In case of 195 foreign citizens, we are not able to, so we have to do all the calculations, etc. Here you get the summary also in the form of TIS. So when the feedback is given, so what you will see that in each kind of feedback, there are some changes, small changes are there. So I have just given, but more or less these are the feedbacks. So information is correct. One can give that feedback, but it's not mandatory that you need to give every time that every time you give or go on giving that yes, information is correct. But one may choose to do so. Information is not fully correct. Information relates to other PAN. So if we know the other PAN, then we need to give that other PAN also. So what happens, suppose in case of housing society. So housing society went for redevelopment, 200 members. Now 200 members agreement is entered into this for redevelopment with the builders and all that. Now sub-registrar will give information of this 200 PAN and all that. So in all 200 PAN, it will be shown that 50 crore or 5 crore transaction happened, but the flat owner will say my transaction is very small, it's not 50 crore or something, but it shows so much big amount. Then if he says that it relates to other PAN, then again will be the problem, because he cannot give 400 people or 200 people PAN number, it doesn't know. So in that case, he has to say that in customized feedback, what is the issue and all that. So information is duplicate, included other information is denied, customized feedback. So customized feedback was not working initially, but I am told that of late recently customized feedback started working. So what is the feedback processing approach? So once we have given the feedback, these are the feedback is given. Once the feedback is given, what department will do? The feedback provided by SSC will be captured in annual information system. Reported value and modified value will be shown separately. So it's not that reported value will not be shown. One line will be reported value, another line will be modified value. So you can see both. This is the reported value, this is the modified value. So modified value may be showing 0, modified value may be showing different amount. So but both will be shown separately and there will be mentioned that is feedback or modified value. Feedback provided by SSC will be considered to update derived value. So based on that feedback, now what will happen? Because that processed value, what is the processed value is on deduplication, which we said up earlier. So after deduplication, processed value is derived. So first, so many informations are coming. Those informations are processed, removing deduplications, which is duplicate, those into is delete. So processed value are there. Now processed value afterwards, considering the feedback, will convert into derived value. So processed value will become derived value after considering taxpayers feedback, and it will be there in this tax information So information assigned to other PAN year in AIS will be processed and so suppose if we say it is related to other year, or we say it is related to other PAN, then it will be processed and information will be. So again, it's not that they will just be sitting silent that okay, it is related to other PAN. So they will go and see if it is related to other PAN, then what can be done. Which department will take this information to other PAN or to other year also. It's not that the information given they just change here. They will, this information will be processed and information will be used for automated rules also. Automated, these things will happen. In case information is modified, denied, the feedback will be processed in accordance. So now suppose somebody says this transaction does not belong to me. So okay, department will accept it. It is okay. But they will also look into risk management rules. If it is high amount, or what could be the reason why this information is given by one particular source is denied by the taxpayer. So it will be based on risk management rules. If it is high risk feedback, it will be flagged and they will take due course of action what is required based on risk feedback system. So we are using certain technical terms again and again. Annual information system, we know taxpayer information, somebody just said. Reported value means the information which is given by the original source. Somebody is filing 26Q, somebody is filing 24Q, somebody is filing SFT return. Somebody from registrar is giving the information, somebody is giving from TCS some information. These all are reported value. Different people give different information to the department, they are reported value. And then when the feedback is considered by the taxpayer, so this reported value becomes modified value. Process value, I said that reported value, out of reported value, when deduplication is done, those duplicate entries are deleted, then it becomes process value. And then that process value, out of process value, after that feedback given by the taxpayer is considered, then it becomes derived value. Now information category is level 1 information, level 2 information, level 3 information. So level 1 information is known as lowest level of information. They are displayed in AIS. So each category of information is displayed by unique transaction sequence number. So each and every information which is given has a unique transaction sequence number. It shows both reported value and modified value. So level 1 shows both reported value, modified. Reported means information received from, modified means after considering feedback from the taxpayer. So that is level 1. So basic information either received from different sources or received from the taxpayer is level 1. Then when it is becomes level 2, when it is processed or deduplication is removed, processed or derived value is determined. This all becomes level 2. So level 2, what happens? Suppose one information, like suppose TDS on rent. So one tenant have been deducting TDS on rent from for each month. So 12 months TDS is there. So this all information when aggregated together of one taxpayer information, information of one particular person of particular category. So then what happens? That will be in level 2. So I know the total ABC, my tenant have deducted rent in the entire year. What is the total of that? That will come in level 2. But total rent received from all the persons together will come in level 3. That will come in TIS. So category 3 shows only aggregated value, category wise, rent, interest, salary. So total value when you see, then that will come level 3. But suppose salary received from one employer, employer A will come in level 2. Total of employer A, employer B's total again. So employer A, employer B totals again, that will be level 2. Level 1 is each and every information. Level 2 is total of that employer A. Level 3 is all salary taken together becomes level 3. So these are the 3 level of informations is being given in AIS. Display of information reported in AIS. So just some examples. Illustration 1, deduplications. So under there is section B1. Section B1 gives TDS information. Section B2 gives SFT information. So in B1, if you see under section B1, TDS information is given. In B2, SFT information is given. Now TIS will report that in B1 or B2, whichever is less. So whichever is less will be marked as duplicate during processing. So you are seeing in B1, you are seeing in B2. Now, but suppose some information, particularly say we continue with the example of dividend. So suppose the dividend information in TDS is less, SFT is more. Then what happens? In SFT it is marked as deduplicate, as duplicate entry. But if for any reason, if SFT information is less and TDS information is more, then what will happen? It will be marked in TDS B1 section that duplicate entry, and sorry, B2 then it will be marked as duplicate because in SFT the amount is lower, in TDS the amount is higher. So in SFT B2 it will be marked as lower and B1 information will be taken. This is deduplication, one illustration I am saying. Illustration 2, taxpayer feedback. So if the feedback is given by the taxpayer, it will be shown in SFT. So SFT information reported under B2 again will show TIS. So we will be showing both informations with the feedback. So we will be reflecting this is based on feedback. So this is a first hand information and this is the information received from the taxpayer. So you can compare the two. Updation in information. Then what happens after considering all the informations of different sources and feedback, then updation is there. So what is the final ultimate information that will come in SFT 17? So original transaction is marked as inactive because of feedback from the taxpayer, and new transaction is added in the view. So processed and derived information is given updated in TIS. So what happens? There are, you know that these are the informations which is coming from the original source. These are coming from the taxpayer as feedback. This is the processed deduplication. This is the ultimate final change and all that. So one may get confused that so many informations are there, but one looks into it very properly, one would know what is the final information which AIS is considering, which will go and as a pre-filling in income tax return. That one can derive from here, one can understand from here. So now this is how the department is giving what kind of category wise. So first I'll just go category wise. So salary, rent received, dividend, interest from saving bank. So these are the different category wise in which information in AIS will come, which were not there in 26 years, but now interest from deposits, interest from parties, others means parties, interest from income tax refund. So now if you see the interest itself is classified into multiple sources, saving bank, deposits, parties, loan, etc., income tax refund. Some more interest we will see later. Rent on plant and machinery. Now rent earlier into I was talking of land and building. This is now on plant and machinery. Winning from lottery, crossword puzzle, winning from horse race. I'm just seeing these 50 items and then we'll discuss some of them and maybe then we'll go to question answers. A receipt of accumulated balance of PF from employer under section 111. Interest from infrastructure debt fund. Now I was saying interest. So again, we are seeing another categories of interest from infrastructure debt fund under section 115A. Interest from a specified company by a non-resident. interest on bonds and government securities, income in respect of units of non-resident, income and long-term capital gain from units by an offshore fund, income and long-term capital gain from foreign currency bonds or shares of Indian companies. So long-term capital gain of shares of Indian companies. Again, this is trading problem. We'll discuss in detail. Income of foreign FIIs from securities, insurance commission, receipt from life insurance policy, maturity claim, survival benefit, or medical all receipts from insurance policy will also be reported. Withdrawal of deposits under National Savings Scheme, NSS, receipts of commission on sale of lottery ticket, income from investment in securitization trust, income on account of repurchase of units by mutual fund, interest on dividend, other sums payable to government, sale of land or building, receipt for transfer of immovable property, sale of vehicle, sale of securities and units of mutual fund, off-market debit transaction, off-market credit transaction, business receipts, business expenses, rent payment, miscellaneous payment, cash deposits, cash withdrawals, cash payment, outward foreign remittance, purchase of foreign currency, receipt of foreign remittance, payment to non-resident, foreign travel, purchase of immovable property, purchase of vehicle, purchase of time deposit, purchase of securities, and units of mutual fund, credit debit card, balance in account, income distributed by business trust, income distributed by investment fund. So this is all information from where and how they will get and how they will consider it. And this again you will look into, let's look into one particular one and then some in minor details. So look into salary. So now salary, they will get information from form 16, part B. So employer while filing 24Q in the annual return is giving the details. So that whole complete information is received by the department. Department also receives 24Q quarterly returns, first, second, third quarters returns. So there also the salary information is given. So when that is being captured, then there may be some other annexure 2 informations based on that will also come. So whatever are the different sources from which they come to know, they will capture those salaries and they will try to bring it here. Now, what happens in salary? An employee claims HRA. So while claiming HRA, he has to give details of rent paid. When he in annexure this 2, TDS annexure 2, the employer gives the information, he collects the information from employee and gives the information to the employer to whom the rent, from whom the rent is, to whom the rent is paid. So while claiming an employee HRA, he gives the information of rent paid to a particular person and his PAN number is given. So from annexure 2, again the information will be taken by the department and it will go in rent received. So from here also the information of rent received will go to the department and you will see in AIS that from annexure 2 rent received is also reported. So like again coming to rent. So rent, suppose now the rent is reported in 24Q. Now 24Q gives only specific TDS people who are paying. But suppose an individual who is paying rent of more than 50,000 rupees per month and he is not filing quarterly return, etc., and filing only collecting and paying at the end of the year total. So he files TDS return but files 26QC form. So from 26QC form they will again collect that the rent is received by so and so person. So the rent information will be from not only from TDS return but also from 26QC. So there are different sources from where they will get the information and they will collect. Like coming into dividend, TDS returns, yes. SFT return, yes. And in SFT return, suppose if the PAN number is not given by the company does not know the PAN number, is not updated, they will try to populate also from the information whether this belongs to this, who could be the person whom this dividend is given with no PAN, but is it through artificial intelligence possible to find out, populate that PAN, and then that will be reported. Now, saving bank's interest again will come from all the saving bank accounts will be reported. There may be some times confusion that bank is reporting on 2nd April in your passbook or 1st April, but in the reporting they may be giving as the March ending this. So there may be some confusion that in my interest which is shown in AIS is not matching with my this is going 2nd April or something like that. One has to look into that and one has to reconcile. So all saving bank account, so many people have so many saving bank accounts. Sometimes they are not aware, defunct, or like I was surprised that Punjab Cooperative Bank, which went in liquidation and all the problems. So they are deducting TDS. Now the interest is not received by the taxpayer, but since the TDS is reported and all that, all those things will be captured here. So one has to look into that. One has to see that all informations are taken care of. So what we saw is that the source of information for the department is TDS, normal, we understand, TCS, SFT, and some challans which are paid directly by the some particular person, individuals, etc., while paying rent, while paying for the payment of purchase of properties, etc. Those all will be there covered. Now, saving banks will be reporting under SFT and all that. Those will be covered. But so many other information they will be getting from there. For example, registrar will be sending all the information of purchase and sale of the land, building, or whatever is being transactions are being happening. So those all will be captured from the information received from registrar of sale of land, building, etc., wherein PAN number, etc., are given. If PAN number not given, Aadhaar number given, if the department has Aadhaar number linked to PAN, they can populate that very easily. Then saving bank interest, one may be confused if there are multiple joint holder, husband, first name, wife, second name. So they are reporting in husband only, not in wife, this. So that is not an issue. But in case of rent, there may be co-owners, they may be reporting in two PAN numbers. Again, one has to take care that how one is the co-owners, joint owners, how rent is being paid, how TDS is being done. This all one has to look into. If there are duplications, one has to look into that part also. So from saving bank, from current account, from this, so many things they will be reporting through cash withdrawals, cash deposits. So the department would be knowing, like I said, cash receipts, cash deposits. So this all information will be available from bank accounts, cash deposit, cash withdrawal, cash payments. This all information will be there to the department to take. Now we file 15 CACB. So from 15 CACB, they will be able to collect all the information of foreign currency transactions. So foreign travels, payment for education abroad, this all information now will be also be available. So education fees, etc., which is paid abroad, or this travel expenses, etc., or so many other foreign currency related transactions which are happening through 15 CACB. Reported will all come in the populated in AIS, and will come to know. As regards security transactions, rent on plant and machinery, I said from TDS return, winning from industry. These all okay. Income and long-term capital gain from shares, mutual fund, etc. How? So they are getting information from NSDL and CDSL. So what happens? NSDL, CDSL is reporting all the information. There were some rumors that some conversation that pledge of shares are also being reported by CDSL and NSDL, or transfer of shares. I am transferring from my one demat account to another demat account is also reported. Or there was also the that is are reported by NSDL, CDCL at the value at the end of the day. They don't know at what price this share transaction happened, actual price. So they report based on the end day valuation, which is not correct. Again, CDSL and NSDL don't know the cost involved in purchase of shares. For example, brokerage, STT pay, transaction charge, stamp duty, and so many other costs involved. So those costs, etc., are not involved. So this long-term capital gain and short-term capital gain, or this profit on sale of shares, etc., is not possible at this juncture for the department to. So because of this reporting, the department has issued a circular that we are not going to consider this AIS information for the purpose of processing income tax return. They will, and these informations they will not consider for processing it. But definitely, in my personal views, they will consider for certain purposes. They will try to match, they will try to check. Maybe they will not take action but of just adding into the income, but maybe they will have some more inquiries or some scrutiny selection, etc., or maybe some other way of looking into it. So there are so many sources through which department would know, not only from TDS, TCS, but from, like say I said, purchase sale of property, from 15 CACD, from bank account transactions, from NSTL, CDCL. Business receipt, business expenses, again, they will be known from like professional fees paid, etc., TDS, this all thing. Maybe in days to come, they will increase these categories. They will take more this. Now, purchase of vehicle. So TCS return is filed. So vehicle seller deducts, collects TCS and reports in TCS return. So department would know while preparing AIS that this particular person has purchased this particular vehicle. And now what happens at times, vehicle is purchased by the partnership firm. The name of bill, they give the partner's name, the partner's number is given. So there may be, it is shown in partner's case that vehicle purchase as TCS also shown in partners, but actually it belongs to partnership firm. Then maybe one has to give that feedback and one has to take care of that, this particular thing is there. Even credit card information, debit card informations, income distributed by business trust, etc. So one cannot take this AIS information so lightly. My income is say just 2 lakh rupees, but I'm doing transactions in shares of 2 crore rupees and all that. How I'm doing such high value of this? One has to, maybe one has received gift, one has received some other way of the funds or savings, etc. So maybe this all will be department's views, queries. Maybe one has to report, one has to reply. There may be rupee 1 or rupee 2 differences that may be because of due to round off. AIS is password protected, capital PAN plus date of birth and incorporation. When to submit feedback, one may preferably one should submit feedback before filing ITR. But suppose ITR already filed, now one is noticing some mistake. So still now also one has to one should consider of submitting feedback because it may go against him. Though they are saying it will not be considered for income tax processing, but one should still give that feedback that there is information is incorrect or information is pertaining to some other PAN or other year or whatever it is. So once I've given the feedback, can I modify my feedback? So the answer is yes. So what may happen, like suppose I have modified only rent, but later on I realize that there is some mistake in dividend also. So I can go and modify in dividend. But in rent, which I already modified, can I re-modify the again same information? I was not aware that I am receiving rent. husband or somebody else in the family member was knowing. I said it is not received by me, but actually it has been received in joint account, which I was not aware of. So earlier I said it does not belong to me. Later I realized it belongs to me. Can I go? Yes, I can go and remodify that my feedback. Only I need to give reason why I am remodifying, what happened. How many number of times I can remodify? There is no restriction in number of times, how many times you can modify. You can feedback you can give any number. So AI's feedback is given through compliance portal. There is a chatbot which gives answers in the chatbot. Means you have conversation as if you feel that you are talking to somebody and somebody. But that chatbot is artificial intelligence based. They take information from all the things I said, like, and they try to give instant replies. One can go to AI's homepage and also look into help this. So this was from my side.